Welcome back. The price of gold is heading for its first annual gain in 3 years, putting it on track to end the year at about 13% higher as investors double down on bets that the U.S. Federal Reserve Board will start to unwind its restrictive monetary stance in 2024. On the flip side of the commodity stack, oil is headed for its biggest annual drop since 2020, as war and OPEC Plus production cuts have failed to propel prices higher in a year dominated by supply growth outside the OPEC group. For more on where gold and crude could be heading next year, we're joined by an expert, Philip Streible, Chief Market Strategist at Blue Line Futures. Philip, thanks a lot for joining us on this final trading day of 2023. Let's start with gold. You see gold prices moving higher. Why and to where?
Yeah, and thanks for having me on, Paul. I don't think we did enough interviews in 2023. I've always enjoyed working with you over the past few years.
Great.
But I do want to say that if you look into 2024, that monetary policy, that drag should really fade. The recession fears should recede. But over time, much of the tailwinds that could happen are in the hands of China. So where we saw China's reopening flat this year, that really impacted several of the commodities. We hope to see a more robust economy out of them, as they will impact many of the precious metals, as they are one of the largest consumers of things like copper, like gold, and other commodities like crude oil. So it's really also a question of, will the Fed have that higher for longer theme? Will they make the rate cuts that we were already factored into the dot plot? And will they make emergency cuts instead of raising how they rose 25 basis points? Those were the expectations. They came out with 50 a few times. Will they make that similar type of backpedaling when they start to cut? At that first rate cut they're expecting in March, what if they cut 50 basis points? I think that's where you really get that tailwind for the gold market. And I really think gold futures can, if we got that close over 2100, I think we could easily achieve that 2160 high that we saw before. And then any kind of breakout above there would really be based upon how the economy is performing. But I think that towards the end of the year, as long as China looks at gold as a good deflation play to get some of their assets out of other, things that have been hit by their lack of inflation, by their lack of a robust economy, and park their money in gold, I think prices go up to easily 2250.
What about purchases of gold by central banks around the world? How much of a factor is that? I spoke with another gold expert earlier this week. He said it's a material factor.
Oh, yeah. And the thing is that it looks like, the way that it seemed like Russia-Ukraine conflict, it seemed like we were operating as one globally. And now it seems like a lot of dividing points have happened. A lot of countries are kind of repatriating some of their assets. They're more reliant on their own borders in order to secure key commodities and things. Well, part of that process was divesting themselves from having such large central bank holdings in other foreign currencies that it makes natural sense to repatriate those into gold holdings. That's why we've seen, gold holdings by central banks reach double-digit levels.
Okay, oil, a huge disappointment for anybody who is long oil in the fourth quarter of this year. What went wrong with oil prices, and can they recover in 2024?
So oil looks like a great asset. It's a great hedge against geopolitical risk, and also it is the #1 hedge against rising inflation. Inflation has come down throughout the year, but justifying a stance where we have this large sell-off in oil, I think, was a little over the top. They allowed sanctions from Venezuela and also Iran to be relaxed. And I'm a little surprised that some of the discussion about putting those sanctions back on because of their involvement, whether directly or indirectly, with what's going on with the Red Sea, I would think that would be some of the chatter. We also saw U.S. production reach new all-time highs, but I think the growth rate of that production is starting to stall out. Some of the rigs and the rig count have started to come down here, and I do think with this geopolitical disruptions, you should see oil prices naturally reach a floor and start to climb again from here.
What about copper, Philip? Copper came down in the second half of this year from the 410, 420 level to the 380 level. Can copper prices recover? And how much is China a factor in that equation?
100%. They're the largest consumer of that resource. We believe that copper is part of when you start to relax things like interest rates and they come back down to normalized levels, you start to see a stimulation of building again. A lot of those materials getting used to try and rebuild and also reignite the economy. So I think copper plays an important role. We like copper anywhere below the 380 level down to about 360. We find that as a value zone. Once you get over the $4 to $4.20 mark, we think that it's a little bit high, and you'll have to look and see what the economy is doing there. The Federal Reserve really has to live up to these interest rate cuts that are expected, and you can't just trust the dot plot. And remember, Jerome Powell, he did go higher for longer. Maybe he holds out on whether or not he cuts rates right away. So it's going to be some volatility. I mean, there's going to be a lot of periods of surplus and shortages, that higher volatility in the commodities. You're going to want to pay attention to not only the interest rate cuts in the U.S., but also the U.K. and the ECB, because those are going to play a direct role in the dollar index.
Philip Streible.